Good afternoon, everyone. It is July 10th of 2023. My name is Robert Rayburn. I hope that everyone had a great weekend. Now, this week's update is going to be a little bit smaller or shorter, I should say. Why? We just had a really short week last week. That said, there were some important developments. So sometimes in those shortened weeks, you can get some important data points that are kind of dropped into the market's lap there, unbeknownst to the wider investment community. So we're going to go through that. We're going to go through what that jobs report had to say on Friday. And then, of course, some of the trading action that took place, which I think is important. We typically don't take a huge focus on short-term action, but given this big transition we think the market is about to enter, the shorter-term action becomes more important. So the three big things that we're going to go through this week are: one, what do more jobs, because that jobs report continue to show expansion, what does that mean for interest rates, inflation expectations, and how does that impact portfolio design, asset allocation, the types of stocks and sectors that we're focused on? We'll go through that this week. Number two, the market did experience its first distribution day on Thursday. That means that for every one stock that was up, there were 6 stocks that were down. Haven't seen that in a couple of months. We've had some big down days over the last couple of months, but we haven't had a wider distribution day like we saw on Thursday. Friday, we saw a failed rally. So again, we want to see, what does that really mean? Is this a big deal? Is it a one-off? Is it a market-wide event? Is it an asset reallocation event? We'll go through all of that today. Lastly, energy appears to be making a turn here. And what does that mean for inflation expectations? It's important because when inflation expectations are heading down, it's usually a function of lower energy prices, or at least part of it is a function of lower energy prices. So it becomes this negative feedback loop. But when that negative feedback loop starts to reverse and starts to turn into a positive feedback loop, that can be good for energy stocks and their valuation expansions. In other words, their multiples start to expand, but also feeds back into higher inflation expectations. So this sort of stagflationary environment that we've been warning about for the last month or so. But last Friday, we got a good jobs report in the books, 209,000 jobs created. Seems pretty healthy, especially when you look at an unemployment rate that's around 3.3, 3.4% or so. Again, this is a very good jobs report. But when you start to strip out certain one-off factors, such as government hiring, private payrolls were only up about 149,000. So a significant drop from the 259,000 that we saw in the June report, which denotes May hiring. In addition to that, average hourly earnings continue to accelerate, up 4.4%. What does all of this mean? Okay, so you have jobs that are slowing, right? But wage numbers that are up. So is hiring slowing because of weakening growth, or is it slowing because there's just less workers out there? So a company that needed to employ 5 workers could only employ 3 because there weren't 5 available? Or is it both? We suspect it's a little bit of both, and we'll walk through the charts that explain that here in a second. Lastly, labor force participation, pretty steady here at 62.6%. The other weakening factor underneath the surface of that employment report was the breadth of hiring has started to decrease, right? So in other words, the net share of U.S. industries that are increasing employment is starting to decrease from about 85% or so down to about 58%. Now, the employment report remains strong, but what we have noticed at an industry level is that outside of travel and leisure, you've had some significant slowing, especially in manufacturing and other service sectors outside of travel and leisure. So what can happen in statistics sometimes is that you have what's called an extreme outlier, where you have one industry or one factor that is up significantly, and it's pulling the overall average up, while most of the individual factors are actually steady to down. And we think there's a little bit of that in today's employment report. So we want to pay attention to that, especially when we look at some of the the economic data that came out this week as well. So on Monday, which pretty sure almost no one was paying attention to the market on that day, it was a half day in the market. Those very, very important ISM reports were kind of dropped in the laps of those who were paying attention. And we certainly were. And what we saw was both the ISM manufacturing data, which is the light gray, the dark gray line, and the ISM services number, the light gray line, both saw significant slowdowns. So within the manufacturing, we continue to see activity that is below the 50 line. The 50 line denotes is the dividing line between expansion and contraction. If you're below that 50 line, activity is contracting. If you're above it, it's expanding. Manufacturing remains in recession. So right now, the U.S. is having a manufacturing recession, as denoted by the ISM Manufacturing Index. The more important part of this report, though, is the services sector. Why? Because it's 72% of the U.S. economy. We saw a very sharp deceleration in the services line. So what this does tell us when we combine it with rising labor cost pressures is that the available pool of workers is shrinking at the same time where the economy is starting to slow down significantly as well. How can this happen? Well, if you have a company that's to grow a certain amount, maybe they weren't growing as much this month as they were the month before. So in other words, they don't need 5 workers anymore, they need 3, but they can only find 1. And they're paying that 1 worker a lot more money to secure that 1 worker, right? So yes, their earnings are down, but they still need to hire maybe not as many people as they did prior, but they still need to hire that fewer amount of workers, but pay them a higher price. This is what we call stagflation, right? And this is where this wage growth is coming from. So the pool of available workers is shrinking. Wage growth accelerated on a 3-month basis to 4.56%, 4.35% year over year. So we are concerned about this because that could lead to higher interest rates at a time when the economy is slowing. In other words, you are hiking rates into a slowing economic backdrop. So in summary, we got inflationary pressures that are actually maybe, we'll get more color next week or this week as it relates to the CPI report, that are starting to bottom out and potentially increase again, while economic activity is decreasing. Combine those two, that means stagflation. Now, a lot more data is going to come in over the next week, but if that is true, it's important. And it's important as it relates to portfolio design. Commodities tend to do well in that type of an environment. Energy tends to do well. Gold tends to do well. Consumer discretionary, not so much. Or if we think of technology stocks and wide valuation multiples, we believe that that sector is in an extreme historic bubble. This is where the danger is in areas like technology, consumer, not necessarily where we are invested. We actually think that the stagflationary environment will cause this asset reallocation out of growth and into value stocks. Now, Thursday was that first distribution day, as denoted by the red X here. And what we would note is that we saw a 6-to-1 stock downside to upside ratio. Again, is this the start of an asset rotation out of growth and into value? That remains to be seen. What we would also note, and this chart doesn't show this, is that on Friday, the market started off pretty strong, ended down, but certain sectors like energy were up significantly, right? So that could be the early signs here of an asset reallocation that, yes, the market's going down because technology is super weak, but you're getting money internally within the market rotating to smaller sectors such as energy or gold or mining stocks, stuff that has more inflation protection. I think that, in other words, rock over paper. And when we think of the valuation concerns, a big part of the S&P 500 rally this year has been technology, communications, high multiple growth stocks, and you've seen the S&P 500 price to earnings ratio significantly expand above 20 times. So historically, and this is the inversion of the 10-year yield. So in other words, when this line's going down, this red line's going down, it means that the 10-year interest rate is going up. So when interest rates are going up, you tend to get PE contraction in terms of S&P 500 valuations, not expansion. If the market is becoming more confident that rates are going to go up and stay up, there could be a significant contraction in this PE. And where has most of the PE expansion taken place? It's been in technology. It's been in consumer. It's been in growth stocks. It has not been in value. It has not been in energy. Those sectors have actually seen PEs contract. So that's where the opportunity is, in our opinion. And this could very well be that trigger of going back into value from growth. Again, we showed this sign or this chart last week, this growth of value. As interest rates continue to rise, is that going to be the trigger for this blue line to cave back down, which denotes value over growth and growth stocks selling off? That's where we are laser focused on. That's where we think the money-making opportunity is right now in the market. It's not to continue to chase growth stocks and that bubble that we think has formed into dangerous territory. It's to buy the stuff that's cheap. It's to buy the stuff that people are not excited about right now. And on Friday, when we look at the oil service sector, this is the OIS ETF on the NYSE. It's just an absolutely massive breakout on massive volume. And so this is very important. We, in our growth portfolios, we do have significant exposure to energy service stocks. We won't get into the individual companies here, but we will say that sector had a very positive volatility alert to the upside on Friday in a market that started high and reversed lower. That is what a very extreme positive divergence, and something, again, that we think is important in the days and weeks going forward. So bottom line here, economic growth appears to be slowing just as inflation appears to be bottoming. That it feels very stagflationary to us. We think the data is pointing to a potential stagflationary environment. That jobs market remains tight. That's what's fueling that. In addition to that, that first distribution day could be the first sign that value stocks are returning the favor. That's where we like the market right now. When we look at the market right now, we prefer value over growth. And lastly, energy and precious metals tend to perform quite well during times of stagflation. So that's what we got for you this week.